Welcome to our comprehensive GBP/USD analysis for the week of November 3rd through 8th, 2025. This report, prepared on November 10th, examines one of the most volatile weeks for sterling this year. The British pound experienced a dramatic 6-day decline to 6-month lows, driven by central bank policy divergence and critical technical breakdowns. We'll explore the Bank of England's surprisingly close rate decision, the Federal Reserve's hawkish stance, and what these developments mean for traders. Our analysis draws from 5 leading sources: TradingView, investingLive, ActionForex, Forex.com, and DailyForex, providing you with a comprehensive view of the market. Whether you're a trend trader, range trader, or swing trader, this analysis will equip you with actionable insights and clear trading strategies. Let's dive into the details. The week of November 3rd to 8th proved devastating for sterling. GBP/USD plummeted 3.4% in just 6 days, falling from 1.3369 to a 6-month low of 1.3008 before staging a modest recovery to close at 1.31484. This represents a weekly decline of 242 pips or 1.8%. The sell-off was driven by 4 primary factors. First, a stark policy divergence emerged between the hawkish Federal Reserve and the increasingly dovish Bank of England. Second, the pair broke decisively below the critical 1.3140 support level, triggering technical selling. Third, the US dollar benefited from safe haven demand amid global uncertainty. Finally, multiple technical indicators confirmed a bearish trend reversal. Despite remaining up 5.09% year-to-date, sterling has surrendered significant gains from its late October high of 1.3787. This breakdown marks a potential turning point for the pair. On November 6th, the Bank of England delivered a decision that initially appeared straightforward, but revealed deep internal divisions. The Monetary Policy Committee voted 5-4 to hold rates steady at 4.00%, narrower than the expected 6-3 split. 4 members, Dingra, Taylor, Ramsden, and Green, voted for an immediate cut, highlighting the committee's uncertainty. This marked the second consecutive 5-4 split, following August's rate cut that passed by the same margin. Governor Andrew Bailey attempted to provide guidance, stating, "We are likely to continue gradual downward path on the bank rate," but emphasized a data-dependent approach focused on wage growth and services inflation. Markets now expect a possible December cut. Sterling's reaction was telling. An initial 50-pip rally to 1.3150 was completely surrendered by session's end, with the bearish trend reasserting itself. The close vote undermined confidence in sterling's stability. The Federal Reserve's policy stance provided a stark contrast to the Bank of England's dovish tilt. Chair Jerome Powell's hawkish turn at the previous FOMC meeting continued to reverberate through markets, with his higher-for-longer rhetoric pushing Treasury yields above 4.50%. Market pricing for a December Fed rate cut fell to just 60%, down from over 80% weeks earlier. This hawkish stance received reinforcement from strong U.S. economic data on November 5th. The ADP employment report beat forecasts, showing robust private sector job creation. More significantly, the ISM Services PMI came in much better than expected, with the price index hitting a new cycle high, raising concerns about persistent inflation. Interestingly, despite this positive data, the dollar failed to extend its rally, potentially signaling a short-term top. Nevertheless, the widening policy divergence between the Fed's restrictive stance and the BOE's easing bias continues to favor the dollar over sterling. The technical picture for GBP/USD has deteriorated significantly, with multiple bearish signals emerging. The pair broke below the critical 1.3140 support level, which had held throughout much of 2025. Even more concerning, it violated the 55-week exponential moving average at 1.3185, the first sign that the corrective rally from the 2022 low may have completed. Price action is now contained within a descending pitchfork pattern extending from the October 6th high. The prior uptrend line has been broken, retested, and followed by another sell-off, a classic bearish confirmation pattern. Moving average analysis reveals an ominous development. The 50-day EMA is dropping sharply toward the 200-day EMA at 1.3265, setting up a potential death cross that typically portends extended weakness. Daily momentum indicators remain deep in oversold territory, yet continue to favor bears. Remarkably, all 5 of our data sources maintain a bearish to cautious outlook with consistent downside targets. Understanding critical technical zones is essential for trading GBP/USD in current conditions. On the resistance side, the 200-day EMA at 1.3265 represents major overhead resistance. Below that, the 1.3247 to 1.3250 zone marks where support has turned to resistance and a major trendline intersects. The 1.3185 level, representing the broken 55-week EMA, and the 1.3140 level, formerly key support, now act as formidable barriers. For support, the 1.3000 to 1.3045 zone represents a key pivot area with psychological significance. Below that, we find the 50% retracement at 1.2944, the 1.618% extension target at 1.2876, and the 138.2% projection at 1.2831. Further down, trendline support sits at 1.2780, with a major downside target at 1.2750. Currently trading at 1.31484, GBP USD sits in a critical zone between resistance overhead and support below, making the next directional move crucial for determining the pair's trajectory. Looking ahead to the next 1 to 2 weeks, we assign probabilities to 3 potential scenarios. Our base case, with 60% probability, sees GBP/USD trading in a 1.2900 to 1.3200 range with continued consolidation and downside bias. A break below 1.3000 would target the 1.2831 to 1.2876 zone, with rallies capped at 1.3140 to 1.3150 resistance. Our bearish scenario, with 25% probability, envisions a decisive break below 1.3000 psychological support, accelerating toward 1.2750. This would be triggered by further Bank of England dovishness or continued USD strength from Fed hawkishness. Finally, our bullish scenario carries just 15% probability, requiring a short covering rally that breaks 1.3140 to 1.3150 and targets 1.3200 to 1.3250. This would require a significant fundamental shift or technical reversal signal. Key events to watch include US CPI data, Fed official speeches, UK employment and inflation figures, and any government shutdown resolution. The balance of probabilities clearly favors further downside. The medium-term outlook over the next 1 to 3 months remains uncertain, with the direction dependent on how central bank policies evolve. Scenario 1, with 45% probability, sees continued decline toward 1.2474 to 1.2750. This assumes the Bank of England cuts rates to 3.50% by February, while the Fed maintains restrictive policy, UK growth disappoints, inflation persists, and we see a technical breakdown below the 1.2780 trendline. Scenario 2, with 35% probability, envisions range trading between 1.2800 and 1.3300. This requires both central banks to ease at similar paces, US data to soften, the UK to avoid recession, the government shutdown to be resolved, and support at 1.2831 to 1.2876 to hold. Scenario 3, our least likely at 20% probability, sees a recovery rally to 1.3500 to 1.3600. This would require the Fed to shift dovish with multiple cuts priced in, UK data to surprise positively, the BOE to push back on easing expectations, and a break above 1.3247 to 1.3250 1.265 to trigger short covering. Different trading styles require different approaches in current market conditions. For trend traders with a bearish bias, the recommended strategy is to sell rallies at 1.3140 to 1.3180 with stops above 1.3265, targeting 1.3000, then 1.2831, and finally 1.2750. This offers a minimum risk-reward ratio of 1 to 2, potentially 1 to 3 or better. Range traders should buy the 1.3000 to 1.3045 support zone and sell the 1.3140 to 1.3180 resistance zone, using tight stops 50 pips beyond the range boundaries and targeting the opposite end for 140 to 180 pips. Swing traders should exercise patience, waiting for clear breakout confirmation. A bullish setup requires a break above 1.3200 before buying pullbacks, while a bearish setup needs a break below 1.2950 before selling rallies. Regardless of style, risk management is paramount. Limit position size to 1 to 3% risk per trade, always use stop losses, reduce positions ahead of major events, scale into positions gradually, and take partial profits at key technical levels. Let's summarize the 4 critical conclusions from our analysis. First, the technical breakdown is confirmed. The breaks below 1.3140 and the 55-week EMA signal a trend reversal, suggesting the rally from the 2022 low may have completed, opening the door for declines toward 1.2750 to 1.2831. Second, policy divergence is driving direction. The Bank of England's dovish tilt, evidenced by the 5-4 vote split, contrasts sharply with the Fed's hawkish stance, creating a fundamental backdrop that favors the dollar over sterling, a divergence likely to persist medium term. Third, there's bearish consensus across all sources: TradingView, investingLive, ActionForex, Forex.com, and DailyForex all maintain cautious to bearish outlooks with consistent targets. Fourth, sterling faces multiple headwinds, including weak UK growth, persistent inflation, fiscal uncertainty, and risk-off sentiment. Our near-term strategy: maintain a bearish bias, sell rallies into 1.3140 to 1.3180 resistance, watch the 1.3000 level closely, and reduce positions ahead of major events. Stay disciplined and manage your risk carefully.